And then when it comes to TSMC, these companies actually I accumulated quite aggressively. Last was around 2022. You can see that I started buying into this company around $66, right? Okay, good morning everyone. Thanks for joining TCSS session. So today's session is all about ASML and TSMC because these two companies, they are the first one to announce the Q3 quarterly earnings. So I'll go through the results and specifically I'll go through some of the charts that I am personally monitoring. I think that's a lot more useful compared to the slides provided by the companies. Okay, let's start from ASML. So this is the chart that I'm looking at because this is showing the total revenues. Green bar is the quarterly revenues, and then the red line is the net income margin or the net margin. So the latest quarter, if you look at the results, right, it still looks not bad. It is 7.5 billion of revenue. It's actually a record revenue for record quarters. But we know what happened after the release came out, right? The share price actually tanked. We get through the reasons later. In terms of net margin, I think it's quite stable. So currently it's about 28%. So for hardware companies that are able to sustain a net margin of 28%, that's quite impressive. And also that's, I would say, probably thanks to this business is still it's a monopoly business. So they have pricing power. But when it comes to revenue, I think especially the outlook, they are not doing that well. This is the free cash flow. So actually, the company mentioned that, okay, in terms of free cash flow, they generated close to 3 billion. 3 billion is actually the last 12 months. So actually, they are still struggling in terms of generating free cash flow. So they provided a few reasons of why free cash flow has been quite low. So I've recorded a few texts here. So low level of order intake, less down payments, and also higher inventory level. So I think this one is mainly because they, when the customer place on orders, right, they have to make some down payment, and the orders has been quite low in recent quarters, and also the in terms of the outlook also has been lowered down. The managements overall, they are feeling a bit cautious when it comes to their order book, and they specifically mentioned that China situations is a bit worrying. Also because this is related to geopolitics. There's rumors that says that US might block China from buying lithography machines from ASML. In terms of what are the blocks, right? Like specifically which product they cannot sell, all those details is not out yet. But there's already rumor and the management is having a cautious outlook. If you look at currently, right, I think China actually contributed quite a significant portions of their business. And this is partly also because China semicon companies, they also know that all these, like restrictions when it comes to buying all these machines, right, will come soon. So they have been buying all these machines and just, as a backup. For now. If the bans come later, I think China's percentage of sales will come down and hopefully other markets, right, will pick up. If not, then we're talking about a much lower growth for 2025 and onwards. That's free cash flow. And then let's quickly look at the valuations, because I think whenever people see that, share price tank, right? Well, is it good time to buy? Because if you just look at the share price, of course, you may think that, it is a lot cheaper now. But whether the company is cheap or expensive, sometimes you cannot just look at the chart unless you are doing trading. So I think we can look at a couple of all these valuation metrics just to gauge where's the valuation right now. So I screenshot this as of yesterday. So the PE, forward PE, this is NTM, stand for next 12 months. Forward PE is about 28 times. So it's a lot more reasonable as compared to, level, let's say just Q1 this year, it was close to 50x forward PE, and also around 2021 when the stock market is in kind of like very high valuation, right? It was also between 45 to 50. So that was considered quite a high valuation. But right now it's back to 28 times. I think it's a lot more reasonable. Whether this is cheap or not, I think it really depends on the future growth rate now. Because when you're paying 28 times forward PE for companies that's high growing, that's definitely cheap. But let's say if the growth slow down, right, then 28 times PE also not that cheap now. Just look at this as one data point. Okay, this is the forward PE, 28 times. The next one is, like I said, you have to look at the forward PE and then you have to look at the earnings growth, right? So this one is combined, these two metrics together. PEG is PE divided by the growth rate. And using these metrics, you can also see that actually it is at 1.4 times. Usually, for those who look at PEG, I think the standard market commentary is that if it is below 1, then it is cheap. If it is above 1, it is considered expensive. But you have to remember, ASML is a monopoly business. So because of that, you cannot expect to pay, like very cheap PE, let's say way below 1. So that's not reasonable just because of how resilient they are, and it is a monopoly business. So, but at least for the same company, you can track this PEG across time, and hopefully you buy at a PEG level that is, at least historically speaking, it is not expensive. So if you look at this chart, we can say that, okay, any level above 2 is expensive. Any level, let's call it like below 1.3 is considered cheap already. 1.4 times, I would say, is on the low side. But you have to remember, it is on the low side because the G, right, there's concern on whether the G will come down in the near future. As we can see, the order books already came down a bit. So take that into considerations when deciding, making assessment whether the company is expensive or not. All right, then the third one I want to show is that I think the G here, right, is usually referring to, past 12 months growth rate. So it is still not forward looking. And then this chart, right, is showing the EPS estimate 5-year growth rate. So this one is analyst estimate, because analysts, they have a view based on various reports, including management commentary. They different analysts come up with different numbers. I think this one is more like just compile all these different analysts, look at the median, and try to judge from now onwards, looking at 5 years, right? What kind of growth rate that we are looking at. So I think the numbers now is 20%. You can actually see there's quite a like a slight adjustment after earning release. So now it's below 20%, but still, I would say still considered quite high at 20%, because we're talking about the 5-year compound rate, right? But all these numbers, when you are looking at analyst numbers, right, sometimes just be aware that the 20% might not be updated, because after quarterly earnings release come out, right, all these analysts, sometimes they take time to adjust their estimates. So as more and more analysts adjust their estimates and lowering their expectations, right, this number can come down. But 20% as of now, if they are able to maintain, even, let's say, like there's no significant drop in this number, right? Because this is 5-year outlook. It's not just 1 quarter, 3 quarters kind of outlook. As long as this number remain healthy, I would say the company is still a good buy now. But sometimes when it comes to outlook kind of things, it can change pretty fast. So this is on EPS growth outlook. Now take a step back, right? After we look at the valuation, we look at the latest quarterly earnings, talking about the order books. Just take a step back and look at the company's financial overall. These charts from App Economy Insights, they're showing the quarterly reports. So for the Q3 numbers, right, the 7.5 billion is the net sales. And just from this chart alone, you can see that where's the breakdown of their sales, and then in terms of how much sales that they bring in, how much actually flow to cost of sales, how much flow to operating expenses, and so on. So let's start from the first one, like in terms of the revenue sources, right? So this EUV, right, extreme ultraviolet, this is the one. This is actually the product that they have complete monopoly, because ASML is the only companies that is able to produce EUV. The others, right, I don't think they are monopoly, because I think other companies may also have the technology to do that. It's just that now I think in the lithography space, right, ASML still command very, very high percentage of the market share, just because of the scale, the quality they have, and so on. If you look at the breakdown here, right, EUV is still less than 50%, because this argon fluoride immersions, this is actually the low, the matured technology when it comes to lithography machine. This is still quite big. I think the percentage of this argon fluoride immersions, I think quite a significant portions actually are machines sold to China. So if China sales come down, I think this number will come down. Right now, ASML can't sell EUV to China. It is banned from selling to China. But when it comes to EUV, there's also like different products. Some is the main one is still the low NA. The NA stand for, I think, the size of the lenses. The low NA is still the majority. they have started selling the high NA machines. I think Intel is the first one that took delivery, right? And so soon we'll see. I think TSMC also will take delivery soon. So I think this is in their sales. Bear in mind that this company, although we say that it's hardware companies, it is monopoly, but still it is hardware companies, right? So you can see that in terms of their sales, right? Yes, they have some, like services, but still all these machines, lithography machines, they form bulk of their revenues. Installed base management, I think this is the services that I just mentioned, okay? One thing I want to get your attention is that whenever a company is profitable or not, actually just looking at this chart, right, you just zoom out and you just see this green bar, right? If it is a profitable business, high margin business, companies with moat, right? Usually this green bar will be very, very fat. Whereas for companies that's like commodity, their margin is in single digit, you will see that yes, in terms of their sales could be a very big number, but you will see that most of the sales, right, the revenue they take in, right, will be spent on, the cost of sales and operating expenses. So for SML case, you can see that the green bar is fairly fat, meaning that quite a number of the revenues that they receive, right, actually flow to the net profit, okay? The operating profit then to net profit. So what it means is that if the net profit is very healthy, the companies will have money to, use it to pay as dividends or to do share buyback, and that's actually the money flow to shareholders. So I would say in terms of choosing company, I will definitely prefer companies that have pricing power and have high profit margin. And you can see it clearly from this graphic here. Okay, let's go through a couple of commentary from the management, which I think the interesting one. For SML, most of this so-called the interesting one will be some commentary that able to explain why the share price tanked quite a fair bit after the release earnings. Okay, so the first one is that I think they mentioned about the outlook, right? So I think this is talking about the investor day. So they have investor days once every 2 years. The next one is actually November and next month. Okay, so they mentioned that during Investor Day in 2022, which was 2 years ago, they mentioned that 2025 revenues is between 30 to 40 billions. But after they consider all this new development, they talk to their customer and try to gauge the demand for their machines and so on. So they say that the 40 billions is definitely not achievable. So they just say, okay, if 40 billion not achievable, they need to update the shareholders, right? So that's when the first time in quarterly earnings or quarterly call they mentioned that, okay, they can't meet the 40 billion. So the new estimate is between 30 to 35 billion. So midpoint, let's call it like 32.5 billions. So that's a drop in terms of their outlook. And that actually hit their share price quite fair bit, because you have to remember in the past, let's call it a couple of quarters ago, there's always this outlook that the company this is a high growth company. So high growth companies, right, people expecting the growth. And when you lowering the outlook, right, you say that your growth rate is not that high anymore. So that will actually hit your share price. Here, again, I have mentioned, right, it's all about the China, and then it's all about the overall outlook of the sector. And when it comes to overall outlook, they specifically mentioned that the area, for example, the matured semicon, for example, the mobile chip, the PC, all these, right, they expected a recovery, but based on the recent quarter and their outlook for the upcoming quarter, they see a very slow recovery. The only area within semicons that is actually growing very fast, tons of demand, is actually the AI side now. That's why that actually pulled down their revenue. If this entire, like the PC or mobile market start to see some growth, right, that's definitely good for their business. Okay, then I think this one is talking about, okay, let me just read out the comments here. I think this is also quite interesting one. Follow up to that is that how much of the push out is a reflection of just the end demand being poor versus maybe several of your customers struggling with process technology and attracting effectively customer to justify the construction of those factories. I think here, right, they comment, the CEO commented about the the growth of the entire semicon, talking about the PC, talking about the mobile. And I think the analyst is trying to make sense like, okay, you are giving a poor outlook. Is it something that affect every semicon companies, or is it like specific one or two? So the specific one or two, I think actually those who follow semicon sectors, they will know, right? Intel has been struggling. They actually have a fab plan for Germany and they postpone it and maybe even cancel it. We're still not sure about it. And then the other one is Samsung. Samsung is also struggling in terms of their operating or in terms of their technologies. So that's why I think if the problem is only these two customers, the other companies are doing well, I think that's not so concerning. But it seems that the commentary given by the management, right, is that actually they are both. Because these two companies that are struggling, that's well covered by the press. But the overall semicon industry is still having a slow recovery. So it's both. So they didn't give up. It's not just one reason. Okay. So I think that's one. And then the other one is that, so now it's talking about the high-NA EUV. I think the high-NA EUV, right? Intel announced that they have took delivery. I think that was some time ago. And then I just want to give you some, understanding on whenever a company like ASML, they have a new product, right? Let's call it like this high-NA, right? It's actually a big project. It's not like they design something and then every year they have all this new product. They actually talk about this since many, many years ago. They have to go through the entire, the engineering, the R&D phase, make sure proof of concept, make sure things are working, and then build the machines and then test it out. And then as they tested all these things, right, they actually have to let their customer run experiment on these new machines and generate data. By generate data, this one is also, there are a lot of things, right? Because all these, company like ASML, they actually spend a lot of money to build all these new machines. And new machines, right, is always, getting a lot harder to build and very, very costly. So, and if the machine is too costly, even if it works, right, it may not be economical for their customer to buy. So usually how they, justify the high prices is that they have to increase the throughput, meaning that these machines, let's say every hour, how many fabs or how many, not fabs, how many wafers can they expose, right? If they can increase the efficiency of all these machines, right, that can help the customer justify very pricey machines, okay? Now, they already have the machines, they already run, let their customers to try it out and then to, have some samples. So I think they are judging based on few things. One is the efficiency, the throughput of the machines. The other thing is that when you print your chips, right, on the wafers, right, the results, whether the quality is good or not. So they are looking on all this qualitative data as well, right? So that's why they now have some results, and then based on those results, they judge whether these machines actually is working or not. And based on the results that they are sampling, right, I think they are quite happy. The customers are happy, the managements are happy. So we should expect to see more, orders for these high-NA machines, and then this will actually power up their sales in the next few years. So this is high-NA. What's coming after the high-NA is hyper-NA. And by the time hyper-NA start to, ship to their customers, right, I think that will be, maybe 5 years or later. The developments in this space is very slow because it is a very, very complex machine. And there's a lot of problem to solve before they can actually running in the fabs. So that's something that they are working on. And at least if you focus on the, the numbers, right, like, let's say if you focus on the revenue numbers, you are looking at past 3 months. Okay, that's one way to look at it. And then, share price tank because of the outlook, right? Outlook is still looking at all these financial number, but we are talking about, 1 month, 1 quarter, 2 quarters, 3 quarters from now, right? This is still focusing on, the financial, the immediate financial. Some people will say, okay, if you follow all these things, you will anyway very slow, right? You need to focus things that is like 1 year, 3 years, 5 years down the road. Is this company is still leading in terms of the lithography? Is there any threat of competitions? All these things you need to pay attention to the engineering, right? So this is where the engineering is. So they are already talking about the high-NA, very super advanced stuff. In terms of their development, their progress is working well. They have the result to show to the customers. So all things are well, at least on the engineering front, right? But when it comes to the outlook, I think this is talking about the industry growth and so on. So this is more towards the macro kind of concern. So sometimes when assessing companies, you need to focus on different things, right? Engineering is one thing, the financial is one thing, so and so forth. So at least for now, I would say the engineering front is having a good progress. That's all about ASML. Overall, I would say that yes, there's some concern when it comes to the outlook, when it comes to valuations getting slightly, I would say, reasonable. But whether the company is a good buy or not, still need to gauge what's the growth rate over the next few quarters. For me, I would say that my current stand on SML is that I'm not buying as of now. I'm continue to monitor the companies, the result, and so on. But I have to understand all these things, right? Because it sometimes just following SML help me understand TSMC and other semicons companies. That's why I've been following these companies now. All right, let's get into another company, TSMC. Okay. By the way, this TSMC, right? I think I shared on X. This is my second largest holding after Nvidia. Very pleased with this holding and with their results. We get into the details, okay? So the first one, same chart, right? This is showing the quarterly revenues and also their net margin. You can see that the quarterly revenues is a record revenue, 24 billions of revenue in one quarter. And in terms of margin, I think margin, if you look at a few of this line, right, from July 2023 until Q2 this year, right, they are hovering around 38% net margin. This recent quarter, you see a big shoot up to 43% net margin. So this is really impressive. That's why their profit numbers looks very good, because margin shoot up, revenue shoot up. So two things that drive the profit actually shoot up, which is revenue and net margin. Okay, looks good. And then the other one to show you is that the free cash flow over the last 12-month basis is also a historical high. Definitely much better as compared to the chart that I showed just now, right, on ASML. So they've been generating quite a decent amount of free cash flow. Next one to show you is this total revenue. If we zoom out, just to show you total revenue, why I want to show this chart is because although we have seen that the quarterly revenue is very high, net margin is very high, but please remember the revenue, the margin always go up when the market is in up cycle. Okay, up cycle means that, you know, semicon, they go in wave, right? Up cycle, down cycle. So at up cycle, because of all this operating leverage, right, they will actually show definitely good results. Just because all the books, all orders come in, revenue is good, everything looks good. But the moment, let's say, they get into down cycle and then their customer have problem, you know, clearing out the inventory. When the down cycle comes, because the expenses is mostly all this depreciation and also machineries, right? That the cost is there already. So if the sales come down, right, and the costs remain the same, right, what it means is that your profit margin will be affected. And if your profit margin affected happen at the same time as your revenue growth slow down, right, your profit will go down quite a fair bit. So that's why please be cautious when you're looking at companies like this, because sometimes when the results looks good, there are two effects beneath it, right? So one is the cyclicality. Of course, when the cyclicality, they are at the top cycle or up cycle, result will definitely looks good. But please remember that when the cycle turns, right, result may get bad now. So in terms of like investing in cyclical company, I would say that you want to take that into considerations, and if can, try not to buy when the numbers look super rosy. You want to buy when, you know, the result looks sad, and then it's definitely at down cycle, and then down cycle you want to, you know, make a positions and just wait for the up cycle come. I think that's a much better approach as compared to look at the result good and then you just run out and buy, right? So the cyclicality I think is quite obvious for a company like TSMC. So in details, just pay attention to, you know, around like end of 2023, mid to end of 2023, right? You see the total revenue, they're actually having a 10% contractions in terms of their revenue growth, 10% drop. It's quite a sad days during those times. So because I invested in this company since 2020, so I've, you know, like riding the upcycle for quite some time, and then in 2023, when the results are bad, you can see that it's quite you know, sad during those days. So with that, I actually learned that for companies like this, there's time for down cycle. So sometimes just be patient and don't, you know, like over allocate during up cycles. So that's my takeaway from this chart. And it's quite obvious, right? Actually, around 2021, there's also some slowdown. So their growth rate, instead of like, in 2020, that was, close to around 40%, dropped to about 10%, right? When they are dropping like this, you also don't know whether they will get into a negative territory, right? The down cycle. But it seems that around 2021, before the growth slowed down to negative, they already pick up again, right? So that's okay. But the period before that, let's say like 2019, or the period before that, about 2017, or before that, 2016, you can see that there's period when the companies experience negative growth. So the cyclicality is real, especially for semicon companies. That's on cyclicality. Then let's go through a couple of the same charts. Basically, we just look at the valuations, right? So this is the forward PE. Forward PE right now is at 20x, okay? But, when down cycle come, right, it's not enough for the revenue to drop, okay? Revenue growth to drop, okay? Revenue drop, then your margin drop at the same time, right? Because it's too sad, the sentiment is too bad. Even the PE multiple also contract. Like three things that decide your share price. Because if you want to break down the formula, right, share price is actually your profit times your PE, right? So profit is your revenue times your margin. The revenue times margin times the earnings multiple, right? These three things can drop at the same time, So that's why around 2022 period, you can see that this is definitely the so-called down cycle set period. The forward PE can go down to as low as 10x. So definitely those are the good time to buy. Now it's at 20x, is already, let's call it like about 2 times higher. But 20x PE, whether this is outrageously expensive or not, I'll say that it's not outrageously expensive, because it gives that, like bubble kind of expensive. I might, like trim down my positions, right? But my strategy is always buy and hold and just, ride for the long term. But if you look at this 20x forward PE, this is market pricing in. Everything looks good. There's no, like slowdown in semicon. So you can command 20x PE. Whether that will turn out to be true or not, I think at least management say it's fine. They are not expecting any slowdown. I also don't think there will be a slowdown, or there will be a down cycle coming soon. I have no idea in terms of the timing. But just bear in mind that if you buy now, you're buying at 20x forward PE. I think this is important, right? So at least you know. Then the third one is PEG, right? PEG, I think for companies like TSMC, the average PEG, let's call it like between 0.5 to about 2 times, right? Right now, it's still not that expensive, because their growth rate actually is quite impressive, as we have seen, right? All this chart, right? You see the growth is doing well. If the growth is doing well, when it comes to PEG, and companies like TSMC, because they are, like quite heavy into hardware, heavy capex. So heavy capex companies, their PEs tend to be lower, because not every dollars of earnings flow to shareholders. Quite a significant portions of those earnings actually need to be spent on capex to fund for future growth, right? And they were always in this cycle of need to invest. Hence, the PE usually tends to be lower. And when a lower PE divided by historical good growth rate, right? That's why you're seeing a 0.8. But 0.8 here, you cannot just compare this with other companies. You need to, like understand the dynamics. At least for TSMC, if you buy now PEG of 0.8, at least this PEG of 0.8 is not like, like historical high. Okay, that's the good picture. All right, in terms of EPS forward, 5 year is 24%, and I think the analyst has been revising their estimate upwards from, like, let's call it like end of 2023, it was still single digit. Now they think that it's going to be 24%. This one, although I don't know the details, but I would expect that the outlooks mainly come from, all the AI chip demand. Okay, at least this is 24%, looks good. So again, back to this same chart, I won't go into the details, just point out 1 or 2 things that I think is important. The first thing is that in terms of their breakdown of revenue, the high performance computing HPC still command quite a high percentage of their revenue, and we all know that's where this is coming from, right? This is all the AI chip demand. Smartphones, you see that it's quite low, and the other segments are all very small. And in terms of the margin, I would say that this company is also high margin. You can see the green bar is super fat, so that's definitely good. Not all hardware companies are having low margin. For TSMC case, because when it comes to the leading edge process nodes, right, they are still almost monopoly here. They have pricing power. And with pricing power, your margin will be okay. Your, like the profitability will be okay. But the moment the next competitors come in, they're able to offer the same thing. So that will actually drag down their margin. But for now, I think TSMC is still leading. And even companies like Samsung, Intel, they are all struggling to compete. So that's why I would say that the quality of the companies, right, is very important for long-term investing. For TSMC, definitely a quality companies. All right, next, just quickly go through a few things that I think is very interesting. Okay, the first one, I think this is definitely questions coming from analysts, right? There's always, like this skeptical view that whether all this AI demand, is it really real? Because what the industry is afraid of is that all these companies, right, they're buying NVIDIA chip, then they are just, like front run, just buy first. Then actually all these chips, right, is not able to help them increase the revenue later. If that is the case, right, if all these things that you buy can't help you generate profit in the future, right, then you cannot, just keep on buying this forever, because it will be too painful buying something that doesn't help you earn profit in the future, right? So there's this, skeptical view on what's the end use of all these chips, right? Ultimately, it needs to become something that's able to help the companies earn money. Then only they can use the profit to fund the future purchase of all these AI chips, right? So that's why they've been asking, like, okay, do you think this demand is real, or is it like a temporary things, a bubble things, right? So, and then the comments from TSMC CEO C.C. Wei, I think is quite interesting. He mentioned that, he said actually to him, right, it is definitely real, because on one hand, they are producing all these AI chips. On the other hand, right, they are also the user of all these chips. Because, say, for example, when it comes to manufacturing all these chips, they have to make use of AI in their processors, because all these things become more and more complicated, and without AI, without machine learning, it's simply impossible, right? Even NVIDIA CEO Jensen also mentioned that actually when it comes to designing chips, they're also using a lot of AI. So the use case is definitely there. So that's why he said that, okay, I think it's real, okay? Okay, I think this is quite interesting. And also he mentioned that for any companies, right, especially the big one, right, all this AI use, right, if they are able to improve 1% in terms of their productivity, that's a huge increase in terms of the saving, in terms of the productivities, in terms of revenues. So definitely is driving the ROI now. That's why he said that he believed that don't worry about too much about this, because as a user, just think of yourself as a user. If you ever use all these AI software, AI solutions, right, you will definitely see the benefits, and that will justify the value or the price of all these chips. Okay, this is about the pricing that I just mentioned. Actually, I'm not sure, for those who followed my channel, I'm sure you remember, I covered TSMC last quarter. I did mention that the companies hinted that they will increase their prices, because the terms that they use is also quite interesting. They didn't say, we will up the price, we increase the pricing. It's not like that. They say, we are going to sell the value, okay? Meaning that their customers recognize that TSMC play an important role. They are bringing value because of their technology when it comes to chip manufacturing, right? So definitely there's value there. And in the past, they haven't been really, charged a rate that commensurate with the value that they brought to the table, right? So now they say that, okay, they try to sell more value, meaning that, in other words, it's increasing the pricing. And so I think this is definitely good for their profitability. And if you just look at the revenue, you look at the margin numbers, right? Actually, it's quite obvious that they are slowly increasing the pricing of their chips. And it's just that they don't openly discuss about this, because I think for TSMC, they work with different customers. Say, for example, Apple, NVIDIA, Qualcomm, a lot of all these chip design companies, right? They work with them. So each of these customers they have their separate arrangement when it comes to the pricing. And it's not just pricing in terms of dollar amount, right? Sometimes there's a lot of all these, terms that is embedded into the contract, right? Say, for example, what happens if their use is low, right? Do the customers still pay for that or not? All these things is still the terms of the contract that they negotiate one by one. So all these things is in a way secret. They don't disclose much because this is like one-to-one kind of relationship. As long as the customer is happy, TSMC is happy, then there's a business, right? So that's why I'll say that here, at least the good sign is that they've been able to sell their value and able to up the price. With that, margin will be good, okay? And hope that this is not just like one quarter kind of increase. Hope that this is like progressively higher and higher margin just because of the value that they brought to the picture, right? And they also need all this money because after they get higher margin, there's incentive to do more R&D, to increase the capacity, to invest for the future. So TSMC, they definitely have to do that. If they are not having a good ROI, they don't have good amount of dollars for their R&D and research, right? Then the problem is not just TSMC problem, it become an industry problem because TSMC can become a bottleneck for the industry, right? So now I think the customer has been willing to pay more, and TSMC taking more money in also means that they have responsibility to invest more into R&D and also into the future build up of the capex. So I think that's definitely a good picture to see. Okay, the next one. Okay, I think this is companies analysts asking. Okay, your last 5 years has been great. Can you tell me that your next 5 years will also be as good as last 5 years? But the answer given by CC Wei also is very interesting. He said that I'm not able to give you the outlook, the 5-year CAGR outlook, but I can tell you that it is healthy, So I would say that instead of like hard numbers, they at least provide some, like qualitative commentary. But the question is, what does it mean by healthy, right? So that's something that the management leave it to the analysts, leave it to you and me to interpret what does he mean when he said that it's going to be healthy. But I would say that for now, just because of a lot of demand on AI side, I think the companies is not too worried about the recessions. That's on the AI side, right? So you have one AI side that's powering all the growth. At the same time, we are all waiting for the recovery on all the, the matured area, which is the PC and also the mobile. So I think, let's say if AI come down and then the mobile side actually pick up, I think that's also good, right? So it balance each other. But all these things, when it comes to semicon, the hard thing is always don't just look at this and think that you are able to predict. I think it's a bit hard to do that. That's why also I think the management has been cautious when answering these type of questions. They can't really give number, especially we are talking about 5 years, right? 5 years in semicon sector is still quite long. Okay, the next one. I think this one I won't go into the details. Actually, they are just talking about, like HPC, whether it gets to 2 nanometer or the A16. A16 is basically 1.6 nanometers. But just to wrap up here, right, it's just to say that, okay, they now already producing 3 nanometer. Now it's talking about 2 nanometer. Even the A16 is also coming soon. So in terms of the roadmap, right, it's still progressing quite well. No competitions when it comes to all this N2, A16. I think that's definitely a good picture to see. I'll say that the company is growing healthy in this sense. So I would say that aside from financials, all this engineering stuff, we also need to pay attention, right? Okay, just to wrap up the whole things. So just want to show you ASML in terms of my holdings. Actually, I only have 10 shares. So it's not a big allocation. It's actually very tiny. For me, it's just to have some exposure so that I have incentive to monitor the companies, just to have one eye into the companies, right? Actually, I forgot when I bought the company, so I have to look it out in the transaction record. As you can see here, right? Actually, I started to buy into these companies. I entered at different price points. Some as low as like 400 plus, some as high as 800 plus, right? So the average, okay, you can do your computations. So average isn't that low, okay? But at least I think at least during 2022 down period, I have added 2 shares at $422. That was quite a good entry, by the way. So I hope that let's say if the price come down further, maybe I will think of whether to add to these positions. But currently at $723, I think it's not, like I say, it's reasonable range, but it's not like screaming cheap kind of buy level. So that's why I say for me, it's currently still monitoring. if able to buy at, let's say, $500, that will be great, So that's my purchase transaction. And then when it comes to TSMC, these companies actually I accumulated quite aggressively. Last was around 2022. You can see that I started buying into this company around $66, right? And these companies, they don't have any split before, but the company is paying dividend. So if you want to compute the overall returns, you need to include in the dividend as well. But I've been accumulating since 2020, 2021 still accumulating. And then 2022, that was when, the price dropped to about $60 or $70. And I accumulated quite a fair bit around this region, right? So after that, I think since the price started to recover, I actually stopped buying, and I think I mentioned before, I wanted to diversify more instead of like focusing too much into all these individual companies. So I've been buying more into ETF. That's why you see after 2022, I have stopped investing in these companies. So, but for now, it's still like, second largest positions in my portfolio. I've quite a decent allocations here. When the market is very skeptical on the companies, around 2022 period, when 10x forward PE, people don't buy. People are questioning about whether China will invade Taiwan. This company keep on spending, the famous 100 billion capex spending, and no money left for shareholders. So during those periods, they have to spend a lot. Really, not much, like distributable earnings to the shareholders. And PE was bad. Basically, the down cycle, okay? During down cycle, things are very sad. People also not interested to buy into this company. But now we are in the up cycle. So you have to, buy aggressively when people are feeling that these companies, in terms of their future, is looking bad now. I think for cyclical companies, it's good to positions that way, okay? That's why for now, for me, it's a buy and hold. I don't really, aggressively adding, even though when you look at the picture, right? Say for example, picture like this, right? 43% margin, and then the revenue growth is all showing very good. People are buying tons of AI chips. Basically, things are looking so rosy, but still for me, just because you can call it like just be more cautious, okay? So I haven't really like adding to this company as well. All right, I think that's about these two companies. I will end today's sharing, mention these things. By the way, this is Terry Smith from Fundsmith. So I think when it comes to investing, right, if you look at how I invest, right, I think the first thing is definitely the quality of the companies. You need to buy good companies. Because if you buy bad companies, right, even if it is cheap, as the result become worse, right, the share price don't care one, they will just drop one, okay? So you want to make sure that the companies is good companies. The question is, what is considered the good companies that is questionable? Because some people think that, good companies, just because you have a very influential CEO, then it's good companies. It's not enough, You need to understand the business model. You need to understand the modes. You need to understand the culture. Say, for example, TSMC, their culture is always that, okay, they spend on R&D. They know that they need the R&D, because without the R&D, they can't have pricing power in the future. All these things is very important. Then you need to separate, right? The good companies means that the quality side, the mode side is taken care for. And even that's the case, say for example, ASML, definitely they have modes, right? Because they are basically monopoly in lithography machines. But remember, don't overpay, because if when the companies is so-called price for perfections, right? Meaning that the investors are thinking that, these companies will grow a lot, and then margin will keep on increasing. Everything will only go up. So if the valuation is too high and too much is embedded into the pricing, right? The result may disappoint whenever all these assumptions get questioned or become invalid, okay? Say for example, ASML, right? I think it's just too much growth being priced into their valuations, sometimes back. So that's why if you overpay, even a good companies also can turn out to be, bad returns, okay? Then the third one, which I think is the most important one, which is that just don't get in and out. I think the moment you get in and out too much, right, you become like a traders. And if you are a good traders, that's not a problem. Good traders will earn a profit. But if you are not a good traders, in out, then eventually you still, like buy high, sell low, then it's also, don't help you in building your portfolio, right? So I would say that if you focus on two things, identify good companies, then you just, like accumulate aggressively when the company's valuations is attractive. And once it's done, right, you just, sit on it, just buy and hold, sit on it, just wait. And say, for example, in TSMC case, right, I bought into the companies in 2020, accumulated in 2021 to 2022. These two are done already. What happened next is just like, keep on, waiting. Just wait and wait and wait and wait, and you can see that over time, as long as the first two things, right, which is that as long as the companies is having good quality, as long as you don't overpay, right, you just wait and the result will come. And in this case, just looking at the past 5 years, the share price already went up by 300%. 300%, okay? This is multi-bagger. Of course, I haven't hold for 5 years, and 5 years ago that was like $50, right? All my purchase price is around ranging from $80 to $130. So not as attractive. I don't have 300% gain from these stocks, but as long as company is executing well, even 300%, I think it's not that hard to get. I think for TSMC, my gain is probably about 100% for now. Still quite a decent returns, right? As compared to those who trade in and out and just trying to get like, the 10, 20%. We all sit on it and let our companies, right, just compound over time. So that is my strategy, and that's the strategy that I'm trying to promote to you all. Focus on the long term. That's all about today's sharing. See you in the next one. Bye-bye.